In this first video, we discuss a fiduciary's responsibility to ensure only reasonable plan expenses are paid, detailing key fee types, administrative, investment, and participant elective, as well as methods of payment like direct billing, asset-based fees, and revenue sharing. A fiduciary must act solely in the interest of plan participants, beneficiaries, and alternate payees to ensure that not only reasonable expenses are paid by the plan. This module describes common types of plan fees and best practices fiduciaries can implement to meet their fiduciary duty to ensure that plan fees are reasonable. Let's start off with types of plan fees. The Department of Labor's Employee Benefits Security Administration, the EBSA, which is the enforcement arm of the Department of Labor, identifies three types of plan fees. One is plan administrative fees. These are fees for plan operations, record keeping, technology services, compliance services, communications, accounting, legal, and trust services. Number two are investment fees that are related to the management of the assets. So every mutual fund, let's say, has an investment fee that goes primarily to the manager of the mutual fund to pay that manager's fees. Third are participant elective service fees, and these are fees that a participant has access to and may elect to use at certain points. Examples of those are loans, quadros, hardships, distributions, etc. So let's look at methods of paying fees. While plan fees can consist of billed fees that can be assessed directly to the participant's account or can be paid by the plan sponsor. Then there are asset-based fees or participant fees, which are deducted from the participant accounts, and when they are asset-based, they are used to reduce investment return. The last method is revenue sharing. These fees are typically embedded in the investment management fees, and they are not always apparent, but sometimes they're used and sometimes they're not. This is a fees and expenses chart. This page shows a diagram showing the constituent parts of various fee components. So the investment management fees, as we've already said, are fees that are deducted from the plan assets. And that deduction from plan assets interprets to a reduction from investment performance. The administration fees and consulting and advisory fees are considered administrative, and the consulting and advisory fees may be paid by the plan sponsor as a billed expense or may be paid by the participants. Together, investment management, administrative fees, consulting and advisory fees represent the total plan fees or the total plan costs.